This is Mike Gallagher, Director of Research at IDEAglobal. We'd like to go through our key 2013 foreign exchange views, and particularly we'd want to highlight a number of key themes that are driving those views. However, just to give you a bit of a taste of what's to come, the core views that we have translate into 5 key currency trades, we think. First of all, we're expecting quantitative easing in a number of major central banks. And that's not only the Fed and the Bank of Japan, but also the ECB. Ultimately, we think this can drive gold to 2,100 by the end of the second quarter 2013. But we're likely to see a rebound sooner to 1,800. We expect the fiscal cliff to be negotiated away, for Europe to be muddled through, and for global central banks to continue to aggressively undertake quantitative easing. This is a better risk environment than we've had in the last 18 months. And this can produce, we feel, an interesting theme. The theme that we think that it can produce is a switch to underlying fundamentals. And particularly, we think that within the developed world, the US will look reasonable, will look further along the road than other major countries. And in this light, we're likely to see a re-rating of the dollar versus other majors. While we don't necessarily see a systemic crisis in the Eurozone of the scale of November 2011 or July 2012, we think that there will be euro tensions which will undermine the euro. And to the degree that these impact not only Spain and Italy but also France, they can actually lead to portfolio outflows from Europe. Combined with what we think will be ECB capitulation, for us this means a 120 story on euro dollar. Our third key trade is the Norwegian and Swedish krona. These are the new darlings of the reserve managers, but still remain significantly undervalued versus the yen, Swiss franc, Aussie dollar, Kiwi. And we think that in the current environment, with the pressures in Europe being acute rather than systemic, and reserve managers continuing to hunt for better alternatives than the G2, we can see a significant re-rating occurring again as we did in Q3 2012. We look for 8 and 7 on EURUSD and EURNOK respectively. Against a firmer dollar, the Aussie and the Kiwi can lose some ground. But the prospects are that Chinese policymakers will ensure that the 7.5% new normal growth story will stick. Consequently, we're likely to see fine-tuning from policymakers in China, underpinning not only China, but commodity demand for the Aussie and the Kiwi. And in this environment, they can gain ground against the euro. Finally, the yen. We see the key issue actually being risk sentiment, and whether the market is risk on or risk off, more so than the prospect of the Bank of Japan being successful in actually boosting Japanese inflation. To go into the themes in a little bit more detail, there's 4 key strands behind our thinking, and then there's a couple of risk factors we really need to talk about. I'll go through each of them in turn and then highlight once again some of our currency ideas. The first issue that we'd like to address is the US fiscal cliff. While this is a near-term issue, it is pertinent in terms of the way that it affects 2013 as a whole. We attach a somewhat higher risk than currently envisaged in the market that the US fiscal cliff can actually hit. And we would actually warn that before the end of the year, the market seems a little bit complacent that a deal will be done on a sufficient timescale. We could well go right to the wire and actually see a deal struck between Christmas and New Year. If we go over the fiscal cliff, even if a deal is struck in January or February, the impact we feel would be quite severe on the economy, with an associated risk of a downgrade from the ratings agencies. And in that environment, we'd be very clearly risk off. We attach a 30% probability to that scenario. Even on the core view of the fiscal cliff being delayed and then converted into a multi-year fiscal consolidation package, we are likely to see more significant fiscal tightening in the US. This is the IMF forecast for 2013, and in the US, the prospect is that we could see underlying fiscal tightening about 1.3% of GDP. Indeed, fiscal tightening's a theme for the G10 generally. You will see here that the cyclically adjusted budget balance, which we economists use for underlying thrust of fiscal policy, is more restrictive in 2013 than it was in 2012. And this is not only due to the US, but also France, the UK and Japan. So this headwind will need an offset in terms of easy money. This is a theme also that's been very evident in fiscal consolidations on a multi-country basis. This graph shows the IMF study of the reduction in government debt to GDP over a 15-year time horizon and the impact that moderate inflation and moderate growth has helped in successfully producing fiscal consolidations. One of the most clear examples of that was the US in 1946, as we see in this graph at the bottom, where modest fiscal consolidation, 3% inflation and moderate growth all combined to produce a significant reduction. The other extreme of Japan in 1997 or the UK in 1918 were where the countries had slow growth and disinflation or negative inflation, and that only made the whole debt burden that much heavier. With this in mind, G4 central banks are likely to undertake substantive quantitative easing in 2013. The Fed is likely to increase purchases from 40 to 85 billion per month, even with a fiscal deal successfully concluded. The Bank of Japan, under any circumstance, is likely to be more aggressive in helping to stimulate nominal GDP. The Bank of England will review the prospects for further quantitative easing and further FLS measures through the course of 2013. And even the ECB, we feel, will capitulate. This all means for us a very constructive environment for gold. Gold's got a very close relationship with the US monetary base. And if you look at the current expansion of the US monetary base and actually forecast it forward alongside gold, then a target of 2,100 by the middle of 2013 is not particularly aggressive. The third major theme is Eurozone muddle through. By that we mean a situation where policymakers in Europe don't fast-track institution building, and realistically that's only a 25% probability after the German election, and somewhat lower obviously beforehand, given that Germany is now in shutdown mode ahead of the September election. Muddle through has various connotations. There can be a muddle through that leaves the market calm and rebuilding risk at times. There can be muddle through that causes policy delays and derailments and dilemmas. And we think that we'll see all of those faces from the Eurozone policymakers through the course of 2013. In terms of the key risk scenarios, asymmetrically they're downside risks we fear in the coming 3 to 6 months. First of all, Eurozone policymakers just appear too optimistic about a recovery occurring. And we can see a recession lasting well into 2013. Ultimately, we think that the ECB will react with additional LTROs, around $500 billion, and also undertaking corporate bond buying on an unsterilized QE basis, and that can be around 200 billion. However, European policymakers are going to find it more difficult when it comes to the political arena. And our second and fourth points here are particular of note. We would point out that in the last couple of weeks we've emphasized the risks of delays and derailments of key policy initiatives such as the ECB banking supervision and the 2014 to 2020 budget. We'd also emphasize that we're seeing signs already of German policy paralysis before the election, as risk aversion by the CDU leaves them inclined to really just try and muddle through, which at times they can get away with, but at times could cause mistakes. Spain and France we'll return to later. The story in Europe is also financial as well as political and economic. One thing that we would emphasize is that we're under a continued deleveraging phase. This is unlikely to be completed for another 5 years as banks continue to reduce their leverage and their loan to deposit rates. This is clearly impacting lending behavior and is a major headwind in terms of the Eurozone economy. And consequently, as we progress into the second quarter, we feel that the market will see the greatest easing prospects coming from the ECB. And this is what produces our negative view on the euro. We'd also emphasize that the ECB and other policymakers are being just a little bit too optimistic about inflation, assuming that inflation will be close to the 1.5% to 2% price stability target. We feel that, if anything, the risks are that disinflation forces could be somewhat greater, just as recession forces this year were somewhat greater than expected. And that can tip the balance in terms of an easy ECB. Turning to key risk factors, we've discussed risk scenarios surrounding the fiscal cliff, quantitative easing. There's potential that some central banks could stop at some stage, take a pause in terms of quantitative easing, but we feel that that's low risk in the first half of 2013. Eurozone muddle through. There's two dimensions of risks. One positive, which we think is a low probability ahead of the German election, where we see increased institution building. The other is negative, where European policymakers manage to make decisions too late and then cause problems for themselves. But in terms of other big risk factors, two are important. Firstly, an attack on Iran by the US or Israel would definitely be a major risk-off factor. However, at the moment, we would see the probability of this scenario as being around 15% during 2013. Perhaps of greater worry in terms of a risk factor for global markets is the scenario of major unrest in Spain and or France. This could be as bad as the 1968 uprising in France, which, remember, prompted a wave of general strikes, violence on the streets, and tremendous pressure on the government, which ultimately triggered, in France's case, an election. This obviously could also prompt significant policy U-turns, which would be clearly a risk-off event because it would create uncertainty at the heart of Europe. This is something that is also evident in our analysis of balance of payments data. We view Europe not just as a fiscal crisis, but as a balance of payments crisis with a fiscal dimension. And it's clear that earlier in the year there was selling of Spanish and Italian government bonds, but quite clearly there was also redemption of bank bonds and deposits in both countries, which were equally important in the portfolio outflows, as shown in this graph here. This graph shows the net debt to GDP. Normally, anything above 50% is pretty chronic and close to a situation of economic collapse. We're left with close to 90% still in both Spain and in Portugal. And the only reason that Greece has collapsed here is because of the massive haircut that foreigners have taken on their Greek assets. We're also concerned about the build-up of foreign investor funds in Spain, Italy and France, which are respectively 1.8 trillion, 2.2 trillion and 6 trillion across a variety of direct investments, equities, government bonds, borrowing from the Euro system, bank bonds and deposits, and borrowing by corporates and households. And it's particularly the borrowing of the banking systems from non-residents that is very large in Spain and Italy and gigantic in France, with over 2.2 trillion of foreign investor money. Any major socio-political event that triggers disharmony and the prospect of a major policy U-turn in Europe could easily destabilize these existing holdings of assets, not only in Spain and Italy, but also France. And that is bad for the euro. If we look at food prices, that has been something that we've been asked about quite a lot, and whether that can cause tensions. It certainly can cause tensions globally, as has been evident both in 2008 and 2011 and 12. This is the United Nations Food Price Index against riots in a number of countries. There can be some tension in Europe, but Europe does have the benefit of the common agricultural policy, which keeps food production extremely high and provides a cap on agricultural prices. But nonetheless, the vicious mix of tight fiscal policy, recession, high unemployment, and socio-economic change are ugly catalysts that can cause more significant social unrest in Europe, and we would warn about that as the major risk factor for 2013. Just to re-emphasize in terms of our core trades, we like gold given the prospect of significant quantitative easing from a number of major central banks. We think that the risk environment can be better in the first half of 2013, but there will still be some euro tensions and ECB easing, and combined these can weigh on the euro. The best way we feel to play that is versus the dollar, given that we see the prospect of the US being seen to be further along the road than other countries, and we can see euro dollar sub 120 into Q2 2013. The Norwegian and Swedish kronas we feel are the new reserve darlings. They're undervalued compared to the yen, Swiss franc, Aussie dollar, Kiwi, and they have some of the same merits that those currencies have. One key theme we think for foreign exchange markets in 2013 is going to be a segregation of the strong from the weak, and we think that the Norwegian and Swedish kronas can be re-rated further. We look for 8 and 7 on EURUSD and EURNOK respectively. Aussie and Kiwi, well, against the stronger dollar generally, we think that we can see the Aussie and Kiwi losing a little bit of ground. But we wouldn't be overly pessimistic as some in the market have suggested. The China story will remain solid because the new Politburo will ensure that growth is 7.5% and policy fine-tuning can be brought out quickly to achieve that result, and that should underpin the commodity complex. Against the euro, the Aussie and the Kiwi still look good. The yen, well, we can see some phases of yen weakness, but we think that that's going to be highly correlated with risk sentiment, that weak yen phases will be driven by risk-on phases rather than the Bank of Japan. After all, if you look at the Bank of Japan's record in actually boosting inflation, it's actually been quite slow, while the changes to the Bank of Japan are likely to prove more painful and slower than people feel. Even so, against the dollar, we can see 85 on dollar yen in the next 3 months. This is Mike Gallagher from IDEAglobal. If you would have any additional questions, then please feel free to email me on mgallagher@ideaglobal.com or call on 44 207 664 0203. Thank you very much.